Hola, ¿qué tal a todos? Bienvenidos a nuestra reunión mensual de Panorama Económico y Financiero. El día de hoy vamos a hablar de la perspectiva económica. Vamos a darle una pequeña actualización de cómo han salido los datos, nuestra perspectiva por asset class. Y hoy tenemos un día especial porque nos acompaña Todd Jablonski, que es nuestra cabeza global de Asset Allocation y la cabeza de las estrategias cuantitativas. Para que se den una idea, Todd está a cargo de algo así como 250 mil millones de dólares en estrategias activas que maneja y nos va a dar su perspectiva de mercado. Entonces, adicionalmente a todo, tenemos, como siempre, Carlos en la parte económica, Federico en la parte de Fixed Income y Thor en la parte de Equity. Estamos muy emocionados. Esta plática va a ser en inglés para que Todd pueda seguir la conversación, pero ustedes van a tener subtítulos en español. Y bueno, y con eso comenzamos. All right, so we're going to start. I think what we should do is we should start to discuss what we were discussing last time, which was the slowdown in the U.S. economy, and maybe give us an update on how that's evolving, and then we can discuss the asset class view for each of the strategies that we have. So let me give you a background of what we have been discussing so far. There's a big discussion in terms of the slowdown that we're seeing in the U.S., how big that's going to get, whether that might turn to something more harsher, maybe a recession or not. I think there's pretty much a big consensus right now that inflation is not an issue anymore. Inflation is moving down and it's slowly but surely moving towards the target, right? So I think the central banks have also transmitted that to us in their respective meetings, but we will always be interested in what's your take on that front. So.
Thank you for having me, Chava. I'm glad to be on the webinar or the webcast. Like I would note, things are changing quickly. You go back 2 employment releases ago, and things looked pretty bleak. You saw some pretty sad news on the employment numbers, and that was the first time, maybe since I would say in the last 6 months, that investors began to think maybe we will have a recession in the U.S. Now, I have good news for your listeners. Number one, we've had a new employment release, and encouragingly, while you saw the one previously rounded down even more, it was a difficult month with some hurricane effects and other unique elements, the most recent data point is a little bit more encouraging. You are finding job creation is happening in the U.S., and you also found the employment rate ticked down a little bit. So among those features, I think you saw the people rush to the other side of the boat and say, maybe we will have a soft landing. As an investor, what I am troubled by is the running from one side of the boat to the other side of the boat. I don't like changing our direction every day on a new release. So we're trying to look through, and our forecast is for a soft landing.
And do you think inflation will evolve as central banks are saying it will evolve?
You know, against all odds, I think this is a victory for central banks. I'd love to know what you all feel, but when you'd say, hey, we can tighten monetary supply and we can arrest inflation, we can bring it down. Boy, the U.S. went from over 9% inflation. Now it's quite possible we finish the year at 3%. So I think it's a victory for central banks, and I do think that inflation stays under control through the remainder of the year and into 2025. The reason the Fed's been so slow to act is they really want to see that tightness arrest some of the inflationary forces. But I'm quite encouraged by what I've seen from the Fed, and we have expectations around the path for cuts.
Okay. So, Charlie, what do you think about the Fed? Do you think they're going to go for 50 or 25?
That's the question now, right? So since inflation has behaved better in recent months and unemployment kind of like bounced back a little bit, I'll say the levels of the economy doesn't look like they need a 50 basis points rate cut, right? So I'm more tilting towards a 25 basis point cut, because I think this is the current state of the economy showing that the economy is into better balance, it's not overheated anymore, and now the central banks can now start to relax, but I think they have to go slow, because otherwise there's still some pressures on prices. Todd maybe can talk a little bit more about it, but I think the expected pace to cut will be to start with 25 basis points?
I thought if the Fed were to cut 50 basis points, what's the market's reaction that you would expect of it?
I think it would be perceived as a negative. I think that's what Carlos was alluding to as well, was the idea that you'd have 50 bips means the economy is very weak, right?
Yep.
And that would
Yep.
send a signal to investors that maybe the U.S. is not on solid economic footing. So I take a 50 bip cut out of the gate as a sign that the economy is slowing pretty quickly. I tend to agree. I'm leaning on 25.
Mm-hmm.
If you also go back, remember the tightening cycle. When we first started to tighten, it was obvious we needed to tighten, right? We needed to tighten by hundreds of basis points, and the first move from the Fed was 25.
Yep.
And I think that they like to signal just directionally, this is the way we're going. We'll accelerate later if we need to. So I think that the market reaction effect and sort of the fundamental case for a new easing cycle point towards 25 bips.
Agree. Yeah.
And the Fed has been very cautious on giving the market any rate cuts, right?
Yeah.
We have been discussing rate cuts for over a year now, and the Fed has always kind of pushed back on that, saying, okay, yeah, maybe we're reaching that point, but we're not there yet. Last couple of meetings, they're starting to change that tone, right? So is there something that they're seeing that we're not seeing in the data, do you think, that's changing their mind?
The Jackson Hole conference recently happened, and there we got clarity. We got a signal, right, from Chairman Powell that, cuts are coming. So I think that's news that affects the outlook. I don't think that we're missing anything. I think that investors were just greedy, Chava. They wanted to pull forward those cuts now. They said, oh, wouldn't it be nice to have some cuts in 2023? That sounds great. 2024 even. They were expecting them to come way too early. So I actually blame the investors. I think that they were the ones to, implant the idea that cuts were coming sooner. And actually the central banks have done a fine job, I think, being very, very patient, looking at holistic data. As Carlos mentions, not everything is heading the right way. You do find services inflation, and housing in particular is pretty tough, right? We're seeing some of the commodity inflation come down, some of the manufacturing, but you still see it in the housing in particular. And shipping costs remain high. I do note this, right? The trouble in the Middle East and the Houthis and the Red Sea, you are seeing shipping costs go up. Last time that had a pretty sharp relationship with the degree of inflation. So I think there are good reasons to stick to 25 and to not rush immediately. There's more meetings throughout the year. From principals' perspective, we think that 75 bips of cuts are likely this year. And you could see twice as much next year, so another 150, something like that.
And that would leave the terminal rate closer to...
Let's take it down to about 250, 350, take it down to about little under 3, right? Little under 3.
Wow.
And that could be enough, I think, to really provide some meaningful stimulus, and it's part of the reason we're overweight equities. I'd be curious to hear from you, Torin, what you're hearing on the equity side, but from a global equity perspective, there's a lot of central banks that are ready to cut and a lot of companies with good fundamentals.
So the main subject on international equities is first the last year equities, international equities, and specifically the U.S. provided more than 20% return. This year we are almost 15% return. So it has been amazing years for equities, right? But we think as investors in terms of risk asymmetries, and we believe that right now the direction of the economy is to a slowdown. So maybe equities are reaching an inflection point. That's for us, that's the issue. And maybe the upside for equities is not as exciting as before, I would say.
I would agree. I don't think the significant upside is there in the way that it was. But at the same time, I still see, good high single digit, occasionally double digit earnings growth. And if you can find a way to keep investor sentiment positive in a soft landing, I am a little optimistic that equities can deliver good returns, maybe not the excellent ones we had.
So what do you think about these indicators, such as if the SAM rule was not triggered this month, but probably the next month it could be triggered? What do you think about the investor curve changing or switching again.
Yep.
What do you think about this type of indicators that make or trigger investors to a risk-off mood?
I think all of the traditional sort of barometers of a recession risk have already signaled problems, right? Even going back 3-4 years ago, we had that inverted curve. As you point out, it's now gone the other way. I think it has a lot to do with the unique circumstance that we're in. We printed so much money during COVID, so much money, that I feel it has created a little bit of a distorted picture of the world. It's almost as though we're using a filter to look at the US economy through all of that sort of monetary printing. So I'm not certain that this cycle will behave just like the other cycles. There is a path forward, I think, where the US economy, yes, admittedly it's slowing down. It could flirt with zero. It could even dip into negative sort of growth levels. But I wouldn't expect it to be shallow, and I wouldn't expect it to be too deep. I think the easing cycle really remains the way to loosen monetary conditions. And while I don't expect, again, excellent equity returns, I am optimistic you could find some good markets across the globe.
So you wouldn't be concerned about the concentration risk of the U.S. equities that are mainly in 7 stocks right now?
This is another question du jour, right? We've talked about that. You know, I didn't think the world's largest economy would end up with such concentration, but it's happened. And I would argue it's a secular force. I think that, in fact, the big are going to continue to get bigger. And when we say 7 companies, it's not as though they have the typical idiosyncrasies of 7 companies. They're so well diversified, so global. I mean, they've got cash sitting in balance sheets and deposits all over the globe. That makes me think that the structural sort of forces are moving the U.S. higher. I will say probably the best trade I made in my investment career tour, and it's been a while, was I went overweight U.S. large cap equities right after the global financial crisis, right around 2010. And I've held that overweight pretty much continually on the idea that those U.S. mega cap giants can keep getting bigger. And to this point, I still think that's the case. I think the biggest threat to them fundamentally has to be government regulation. And at times I've heard the American left and the American right get dissatisfied with them. But neither the American left nor the right seems to have the willpower or a mandate to go regulate. So until I see regulatory threats, I think, again, these giants can become even yet larger. How long until, I've asked this one, how long till we have a $5 trillion US company? We've already got about a 3.5. Do you think in 5 years you might have a $5 trillion firm? Could happen.
Yeah.
Maybe a couple. Those are staggering valuations, right? Staggering. While it's concentrated, I rely on the diversified nature of the businesses, the global footprint, and a transnational nature to achieve diversification, even through a small subset of U.S. megacap.
And while we're still talking about the Magnificent Seven, something really interesting in the last year was that these Magnificent Seven, they were doing very, very well in terms of performance because of the cash, how much cash they had. But my question is to you guys, what do you expect from them if we have a soft landing or rather a hard landing?
We might get different answers, but I'll go first. I'd love to hear Thor's ideas as well. I actually think they can be defensive names. They have very, very predictable earnings and cash flows. To have an ROE, you say, how do these companies separate themselves so much from the rest of the universe? The return on equity, the ROE of those 7 names, is around 65 to 70%, where the most of the market is in the teens. So it is that excess profitability that makes me think, I'll be curious to hear your thoughts, that maybe in a risk-off environment, people like the predictability and the stability of those types of equities.
Completely agree. Actually, their CapEx investments, they are at the beginning of a new CapEx cycle. So they are ramping up their CapEx investments so they can invest in artificial intelligence, what we all know. But investing in artificial intelligence makes companies more efficient, more lean. So they are only becoming more asset-light businesses. So when a slowdown comes, if it comes to the US, they will be only more efficient companies, and they will be more prepared with. They have the cash, and they can offset any kind of downturn. So I would completely agree to say they are defensive names in a soft landing or hard landing.
And interestingly, we can also talk about increasingly offering dividends. Mm-hmm. This is a new feature I've actually really begun to enjoy as an investor, is the return of capital, right? The idea that investors can, again, clip that coupon. You've seen an increasing sort of dividend exposure from it. It's not a high-yielding sector. I want everyone to understand it's not the place to go for yield, but it is a place that investors can look at for income, right? Now, at the same time, we've been talking a lot on equities. I'd also point out rates are getting in vogue too, right? Equities have been popular. Tor, you've been popular. Now sometimes you have to sort of look around and say, what's going to happen on the bond side? And what you see is falling, duration is being extended. Investors are quite confident that the Fed cuts will allow for a fall in some of the long-term rates. So among my peers in the asset management side, I've detected a move towards longer duration and higher expectations for fixed income. I don't know, Federico, what are you hearing? In my mind, investors are seeing more opportunity with duration. Rates have already reset at a higher level. That's part of the reason why, equity is attractive, but bonds seem to have improved their circumstance from earlier in the year.
Yeah, we like them a lot. And for specifically the U.S. Part of the world, we do think that if it gets up to a soft landing, probably the 10-year will go down probably to 320s.
Yeah.
Maybe then come back to 350s in, let's call it a medium term, but it's going down by a lot. And if it comes hard landing, well, this is party for us. Not for the rest of the assets classes, but for fixed income. If there is a hard landing, we will see the 10-year in 2%, something like that, easily, and the 2% will come really, really fast. So our strategy in the way that we think is to have long duration strategically, and tactically we can have a higher duration, then lower it if it comes the levels that we are seeking. But the long-term position is a higher duration.
The other thing I noted was at the end of the second quarter, so when we were in July, rate volatility had been high. I was looking at bond returns, and in fact, they were at the extremes of sort of like 87% of full volatility, right? Or you'd be in the higher percentiles of volatility. But it has now actually seemed to come down volatility-wise, even as expectations have improved. Have you seen that as well?
Yeah, I think that has to do with the type of information, economic information, that the market was looking for. If we go back up to April, in April, the rates went up. And the reason was because the people were thinking that the U.S. economy, perhaps it was reaccelerating, and it didn't. So at that part of the cycle, the question was exclusively regarding inflation, if the inflation is going to the target or not. So in July was the first month when the inflation, or perhaps it was in May, and then the another data came from the CPI, the inflation, and it showed that the inflation wasn't there to have that impact on the market. So I would say that the market transition from inflation to growth probably in July and August. So now the worry is the slowdown, how the impact will be on growth. You also mentioned it before. Jerome Powell, the governor of the Federal Reserve governor, he told it in the Jackson Hole symposium. He said, we think that the inflation is going to target, and now what we don't like to see is a cooler U.S. employment. So I think that the entire point now is exclusively to the labor market or / growth.
Yeah, it's the dual mandate, right? Yep. Do you want inflation control, or are you looking for full employment? Maybe they can get more employment at the same level of price stability, right? I think we're all in agreement. Cutting makes sense. It's just a matter of the speed.
Yeah.
And the cycle. I don't know. Carlos, I'd love to hear your thoughts on this. My idea is could be a little bit of a shorter cutting cycle. It could be a little more shallow than typical. Is that, I don't know, but I've read other views as well. Do you have an opinion on it?
Yeah, I'm on your side. I think it's things are not looking that bad as the market thinks, and I think that gives space to the Fed to go gradual on rate cutting and maybe, it depends on actually as well what world we'll have in next year, in January next year, in particularly in the U.S., who's going to win and what implications can be that for inflation and for eventually for assets and stuff. So I think the Fed has to be cautious and there's loads of space, right? The rate is at 5%, so there's plenty of room to move gradually. And I think the Fed is going to be cautious about it.
Okay, so maybe Todd, we can discuss a little bit about the different scenarios that are possible in terms of soft landing, hard landing, and how that might impact the different asset classes from your point of view. So maybe we can start with the soft landing, and how would that look for a multi-asset portfolio?
It's an important question because it really matters, right? The macro condition matters. And a lot of the asset classes that have been out of favor actually, I think could return a little bit into vogue if you get a soft landing. So let's talk about which ones those are. Small caps would be a place to start. Small caps, at least in the US, have gotten to be a kind of a smaller part of the market. As the big have gotten bigger, it's kind of pushed those smaller names down to a smaller rate. It's about 4 or 5% of the US market, or about the size of one of those magnificent 7, right?
Yeah.
2,000 companies with the same valuation as one. But amid those 2,000s, you have seen investors underweight, we're underweight. It's a more cyclical exposure. But I can see opportunity for small caps if we get a soft landing. Investors have moved away, valuations are significantly lower than large caps, and from a sector perspective, it just gives you a different, more cyclical sort of mix. So I would look at small caps. If we get confirmation of a soft landing, I'll be looking at small caps, I think, pretty intently. And on the fixed income side, we have reduced some of our exposure to non-investment grade credit. Now, to be clear, I still like the asset class in our global multi-asset portfolios, but we have pulled back on some of those overweights, and we found better opportunities in investment grade corporates and in preferred securities. In particular, I'd point to preferred securities. They are great diversifiers, right? When it comes to fixed income, you get a lot of spread and a lot of rate, and those two things determine a lot. But the idiosyncratic features of preferreds give it a little bit of a differentiated performance. So we've moved that way now. If we get confirmation that there is a soft landing, I think more tech, you could take a look at, again, some of those non-investment grade credits. If you're going to lend money to someone who's a speculative borrower, you want to do it when times are good, not when times are bad.
Right.
And sorry, no, I have a question, Todd. And in this environment that is changing, and there's another asset class that we usually, leave out of the conversation, but I think it's now important to talk about it. What about alternatives? Do you see any opportunities there?
Absolutely. Alternatives have gained in popularity, I'd say at least over the last 10 to 15 years. You've seen a steady growth of the ability to invest in illiquid investments, direct real estate, infrastructure, all those types of alternatives, even real assets, things like that. And I think they just continue to gain in investor popularity. Yeah. We've seen this democratization of privates. What used to just be reserved for the most sophisticated institutions is now available to retail investors in Mexico, United States, throughout Latin America, across the world.
Yeah.
On the upside, I think it allows investors to express a view, to invest in just the one thing that they think is going to have the right fundamentals, that right set of toll roads or airports or bridges or other kind of infrastructure projects too that can lead. While that unitization happens, I think it gives investor choice. The only thing I'm watching out for, of course, is liquidity, right?
Yep.
Many of these investors, these are new asset classes, and for the first time they might find out that I can't sell it tomorrow. I have to wait until the end of the quarter or maybe perhaps to the end of the year. I think the liquidity balance, though, that's where the premium exists. You get that illiquidity premium. So we are finding opportunities in alternatives, at least right now. Our favorite idea in the alternative space is around commodities, where in fact I think you've had a structural underinvestment over a long period of time. And while they are cyclical assets, just like those small caps I talked about, I'm willing to go early on the commodities. I want to wait on the small caps and maybe the credit, but on the commodity market, especially in precious metals, you are finding, I think, pretty unique growth. That copper has been up and down. Tin has had a very, very successful 2024, and gold. For the first time in my life, Carlos, I have never been a gold bug. Never. I've never overweighted gold in multi-asset portfolios in the entire 20 plus years I've been doing this. But this year was different. I actually saw some pretty unique supply and demand forces that drive price that actually made gold look attractive on a tactical basis. And that's just one metal. I view it as a metal, fundamentally, among many that I think could offer some interesting alternatives diversification.
And let me ask you a question. What do you think about gold miners? Because there has been a lot of expectation that gold miners eventually will take off. And they started to return a little bit, but they have been disappointment, let's just say, for a long time for many of the gold bugs.
Miners have been difficult, I think, for investors to find good business models. There's the value of the actual precious metal extracted from the earth. That's one thing. Then there's the value of an enterprise designed to do that. And there you can have efficient management, inefficient management, political risk, low political risk, good profitability, low profitability. So I've had less success looking at the miners to play that view and more success playing the direct commodity.
Okay, excellent.
But Todd, do you think it's only supply and demand dynamics that has driven gold this year to be one of the best asset classes this year, or you think there is more behind this rally?
I think you find there is, when you say more, the first thing that comes to mind is you do find a certain set of investors who like the stability of gold as a way to sort of medium of exchange, almost like a currency, right? It does have that factor. But when I talk about supply demand on gold, I'm referring specifically to, one, the Chinese central bank, and two, demand out of India. The Chinese central bank has steadily been increasing not just its reserves of hard currency, but also its reserves of gold. So that's a persistent demand increase, right? That downward sloping line kind of shifts up a little bit. And India, which is scheduled to become the world's third largest economy in about 2 or 3 years, you find this collectability and sort of this other sort of cultural demand for gold. I think having the two largest countries on the planet, that's 2 out of the 5 billion people right there interested in gold, is enough to nudge just the demand. At the end of the day, I look at oil, gold, any other commodity as a function truly of sort of supply and demand with the occasional idiosyncratic market force.
There's a big expectation on the equity markets that India is going to keep outperforming. And China has been an issue for the last couple of years in terms of their equity performance. Do you think it's a dead market, or do you think it eventually will rebound?
Please do.
The hard one to tell.
The hard one to me. India and Chinese equities markets behaved pretty similarly, actually with a pretty positive correlation right up until COVID. And when COVID hit, and our treatment of that virus went in very different directions around the world, that is when the two of them began moving in different directions. So while I'm optimistic that the continuation of the Indian sort of rally can continue, you can't take your eye off of China for too long. Every time I've seen a bottoming of what people thought might be a bottoming out in the Chinese market, you've seen just enough of a rally to get investors interested again. I still think China is fundamentally a policy-driven market and a credit-driven market. It will be back in vogue. I'm pretty confident of that. But right now, the demand for credit looks a little weak, and right now the policy response looks a bit underwhelming. I would prefer India over China tactically today.
Yeah, in my opinion, I would say I would agree with what you said, Todd. But for the short term, maybe China is not a good investment right now. We have U.S. elections coming in the next months, and the narrative of the U.S. right now, it's against China. It's becoming more and more the narrative of the U.S. to decouple or to have an economy that doesn't depend on China, and it's actually focusing more on Mexico. That's why Mexico has been trending in the last couple of years with the nearshoring theme. So China, I would say, it's not an investable market in the short term, and India, on the other side, it's pretty hot. Valuations are pretty high, but the economy is super solid. GDP revisions have been trending upwards for year to date, and it's above 7% real GDP for this year. So even though it's a pretty expensive market, but it hasn't shown any weakness on the economy, right?
Agreed. And I've looked for growth globally. I think in the developed markets, U.S. is in the lead. You find the Magnificent Seven have been driving that growth story across DM. And on EM, I'm with you. I think that India can do that. I think Korea can do that. I think Taiwan ties in nicely with the U.S. mega cap story. But let's also forget and value opportunities in EM as well, right? That's the growth story. Yeah. And on the valuation story, I see LATAM, right? It's Mexico, it's Brazil, and Chile all offer really good valuations. My question for you, Tor, is which of those three markets unlocks first? They're sort of between Chile, Brazil, and Mexico. Each of them is trading, again, at pretty good discounts. Do you have sort of a regional favorite?
If we are saying we are bullish on commodities, I would say first it's Chile. We already had a derating of the equity market in the last 2 years because of the constitutional reform that didn't went through, but it has been for a while under a derating period. So the first one, if we expect commodity cycle to the upside or a rally, then Chile would be the first because it already went through all these political uncertainties. And Mexico is just at the beginning of one period of a lot of volatility and a lot of uncertainty in terms of political noise. In Brazil, it's not in any case extent of this political noise. They have it's the most indebted country in LATAM. Although GDP expectations have been upwards in Brazil, but it also has been coupled with higher inflation. And now we're talking about higher rate cycle in Brazil.
Yep.
So that doesn't bode well for equity. So I would say first it would be Chile. In second place, it would be probably Brazil. And on the last... unfortunately, on the last place, I would put Mexico because there are a lot of question marks around the political uncertainty in Mexico.
Do you think foreign investors have it right, Federico? Do you think foreign investors actually can measure political risk appropriately in Mexico?
That is a very hard question. And I can always think that the people who are in the ground of where the noise is coming from, they're seeing more details and they are more focused, and the news are coming, they have so much news about it that I think that most of the times the local investors are only seeing the one tree instead of looking out and zooming out and seeing the entire forest. So sometimes I would say that foreign investors are more ease in terms of the noise, political noise particularly, but sometimes, and I would go straight to Mexico here, perhaps the foreign investors are missing information, are missing particular things that are happening that we are able to see because we are reading and we live this. And in this case, Mexico's case, I would say that we are probably more negative in terms of what's happening and what might happen rather than the foreigners. I give you back the question of how the global investors see Mexico within these political changes and the reforms. Do they like equity, fixed income, what are they thinking about the peso? What's the global investors' interest in Mexico?
I think you're right with your analogy between the forest and the tree, right? In some ways, I would also note that just about every local market investor I've met is more negative on their home market than they are on others, right? Yeah. The great Sima Shah, who I think is an excellent investment strategist, has been very pessimistic on the UK for a long period of time. I've been pessimistic in the US at times, not lately, but at times. So I think that literally as global investors frame the picture, they do take into account that the local experts often are more negative, right? And that is that home country, I wouldn't call it, it's like home country criticism, right? We feel, perhaps we all feel more able to criticize, the things that we know well. Yeah. At the same time, I think you are dead right in that I think investors, foreign investors in particular, probably need more detail to fully comprehend, what is the level of political risk and what would shift in terms of the functioning. The peso looks cheap. I'll say that right. So long term, I think the peso looks pretty good. You could see some additional noise, heck, this month, maybe later this year on the peso, but I think it's fallen quite enough already. And if you get another shock, I don't know, the fundamentals to me on Mexico look attractive enough. I think I'd be a buyer of the peso if we saw another pullback. And that's an idea that I have heard across foreign investors in Asia, in the States, in Europe, is the idea that if there's any additional leg down in Mexico, that they might take a more favorable view. Now, what I have seen in particular is in favor are credits. You do find a lot of credit opportunities, and the carry is here right now. We should start with that too. The carry is here right now. You get 4% inflation, you can get a 3% real return. That looks pretty good relative to the global perspective. And alternatives, as Carlos mentioned. You are finding that, again, people are looking to Mexico because they see the nearshoring opportunity. They think there will be good for U.S. and other foreign direct investments. That kind of opportunity gives rise to real estate, private equity, private debt, infrastructure, the kind of key components into an alternatives program. Those are the two markets I sense the most investor interest. On the equity side, I think it really boils down to fundamentals. And when you see that cyclical acceleration, I would agree now's not maybe the time for that cyclical acceleration, but when it comes, I have seen foreign investors recognize the potential in Mexican equities, and it's a deep enough market to hold sizable investments.
All right, now let me ask you, just to close out on the equity side, what do you think about Europe and the other developed markets, Japan? There has been a recent increase in performance. However, we have seen valuation consistently below what the U.S. tenders have been making. So do you think that's going to shift somehow, or do you think the equity is just going to become 90% U.S. and 10% the rest?
It can't go that way. No one would like that. Look, the rest of the DM space has had competitive disadvantages. When you look at the efficiency of a European company, even a German one, against an American one, you typically find better profitability and better operating results from the system that is operating inside the U.S. We've been underweight on Europe for a while. And to be candid, I travel a lot. I see the world. I see way more dynamism here in Mexico than I see in Europe. I see people launching new ventures, trying new things, making use of technology without, with the appropriate amount of regulation. In Europe, boy, I don't see that kind of dynamism at all. The Japan story, though, is, I think, a unique situation, right? You had an economy that had been shrinking and dealing with deflation as much as anything else, and an aging population, and then all of a sudden, what did they get? Inflation. It arrived at their door. COVID does a lot of things. It causes harm, death. It also causes inflation, is what I say. COVID and our treatment of it causes inflation. I think that awoke sort of the Japanese equity market. You had that very positive carry trade situation, which moved very quickly to unravel. I'm still overweight Japan, Tor. I still think Japan has legs. Even with the pullback. We have still made money on the tactical view. It wasn't a big pullback. I think investors have it in their mind that it was a really sharp pullback. But ultimately, if you had invested, over a good period of time, it's pretty minor. I think Japan has opportunity. And EM is that mixed bag, right? EM is a very mixed bag. So Long term, I do think we've seen the equity shift more U.S. I don't like it. I think choice, different currencies, different sector and industry mixes, that's good. I think the Mag 7 will drive that more than anything else. What I'd like to see is EM return into vogue. Dora, I don't know your thoughts on that, but it's been a long decade for global EM investors, and boy, if we got a rally out of China, some sort of, maybe Brazil, as you say, you're not so optimistic, but a rally in EM equities would be welcome, I think, by foreign investors.
It is in our interest that EM comes back to the table.
It's tough. I mean, I looked at I owned an emerging market ETF, and I was looking at my personal account about last year, and I'd held it for almost a decade. And you know how much money I'd made in that emerging market ETF?
Zero.
Basically zero.
Yeah.
Basically flat for 10 years.
Yes.
Now, as I look around, I see a lot of wealth creation. I see a lot of good ideas and new companies. And what's it going to take to unlock that opportunity?
It's mainly China, right? China, as we already discussed, China is the main issue. Right now, it's not the best timing for China because of U.S. Presidential elections. But coming back to Japan and Europe, well, they also their currencies are appealing, right? The euro has appreciated in the last 10 years against the dollar. That's something, and the yen with now inflation, positive inflation, higher interest rates. It's looking better after maybe the unwinding of the carry trade, right? After that, Japan has structural reforms for minority stakeholders that are for the benefit of investors. They are promoting higher dividend yields, higher repurchase for stocks, and valuations. Many Japanese stocks have a lot of cash, almost 30% of cash for 50% of the total Nikkei index have 30% in cash because of earthquakes, or there is a strange story there, but the price to book values adjusted for this cash, it's looking cheap. So there is a structural things in Japan that look appealing for the long term. Probably the short term, it might be also related to how the U.S. is going to perform. The U.S. impacts the risk of mood or risk on mood on global equities, and in Europe, I would say it's as you already mentioned, it's less attractive. There are not many technology companies. It's and the growth, right? Growth in Europe, it's not very attractive. It's close to 5% this year, and we have two close wars. So that could that geopolitical risk could have a direct impact to the economy of the region.
Yeah, and in terms of Europe, I will add, in terms of macroeconomics, the bet of Europe in terms of growth was one based on cheap energy coming usually from Russia and exporting their goods to mainly US and China. Well, we are living in a world where the Russia channel is now blocked, because of the Ukraine-Russia war, and so they are finding it difficult to access the cheap energy input, and they are finding problems on their demand on their products because China is not going through a nice demand side. So I think Europe in terms of if you put all the pieces together, it doesn't look that attractive as compared to other developed markets, as we were discussing, US, Japan, and maybe it's time to look for opportunities in other regions, right? As we were discussing about LATAM and all the other countries.
Or even, I think it would take a value rally. If value equities really rallied, I would take a good hard look at Europe. There are really strong banks, good financial institutions.
True.
You do find a couple good consumer names that are in there, and finally you find some pretty decent manufacturing. So again, if we see that shift into value, I might take another look at Europe, but to date, it's been a growth dominance for a couple decades. I'm still relying on the Magnificent Seven. At some point in time, an equal weighted S&P 500 might make sense, but I don't think we're at that point today. I'm still willing to be overweight the mega caps, then kind of aim in that middle of the market.
Yeah.
And EM plays in that as well, because EM is a value play mostly, right? So at least for LATAM it is. So if you get a value rally, that might spark an EM rally as well. Now, sorry.
There was a time though when EM was synonymous with faster growth.
I know.
Right? In the 90s, I remember it well. I was doing it like EMs were growing faster. If you wanted to escape the slowness of developed markets, the only way to do that was to look at DEM. So a little part of me, Chava, yes, you're right today, it's about value, but wouldn't it be nice to get into a circumstance where I can look at EM as a growth engine? That, I think, is something that would be really powerful, would draw a lot of investor attention. It's relative, of course, to DM, but that growth rate could make a big difference.
Yes, definitely. And at least LATAM is very well positioned for that story because of the demographics and all of that's pushing growth to at least to potentially higher levels than DM markets.
Certainly, most DM countries would trade demographics with an EM market very, very quickly if they could.
Yes. So we have not spoken much about bonds. Let me just give you a quick input. We have seen U.S. rates rally a lot in the last couple of months. Mexican rates have not rallied so much, obviously by political reasons, all this uncertainty that coming around the reforms. But do you expect that Mexican rates will eventually catch up to U.S. rates?
Yeah. I would start there. Because of the Mexican risk premium, which is how much an investor has to ask for a particular tenor, a particular bond, to have a higher yield. So that has gone up since the election, and the most important part of the curve of the Mexican bonds is actually what is happening in the U.S. curve. So what we think is going to happen, and we already discussed it for a while, is that we think that it's coming a soft landing. And if we don't have a soft landing, we will have a hard landing. In either case, that means that the U.S. curve will go down. And since that is part A of what moves the Mexican asset, the Mexican curve, the Mexican curve will go down. If we have a soft landing, that is the Goldilocks for the bonds. I do think that for the end of the year, the nominal Mexican curve will go down, specifically because of the U.S. curve. And even though if we take a picture, if we use a big picture, I think that the curve is really, really high. If we analyze it for the last 20 years, we are in not at the cheapest, but we're kind of close. Yeah. So I think that for any investor, if it's for the short, medium, or long term, it's what they should do is to buy and hold and just live with the volatility. But anyhow, I think that the duration is going to pay a lot in the medium and long term, even though the risk premium will stay high.
I just want to give you a little context. Mexican rates, you can get 20-year real rates in Mexico for 5% after inflation. So I think we don't need rates to rally. We just need rates not go higher. And you're going to get a significant equity-like returns from it.
So that's why the popularity is here for the carry trade, right?
Yes.
I mean, with relatively low risk, global investors can produce a pretty positive rate of return here in Mexico. It's on the global radar screen, right?
Yes.
Is that the opportunity is here. I'd like for it to be a more sticky sort of investor interest, but for now, I think it at least elevates Mexico and investors' minds.
Definitely. So let's start to wrap up now. So I think what's most important is we discuss our base case, which is a slowdown, but not a recession. What would change on your positioning or your views by asset class if we were to get a recession?
Oof. If you get a recession, if you get a hard landing, owning long duration, safe, we call them anti-fragile assets, headlined by 30-year treasuries, would probably be my favorite asset class, right? It's hard to know that before everyone else. People digest information at the same time. But I'd take a look at long duration, I'd take a look at treasuries. I would pull back a bit on some of my spread appetite. And I would start fishing in equity space to see, what things tend to collapse at different. If you get a shock, you might find one market, down 10, maybe another market down 15. I'd probably begin, combing through those equity markets, trying to understand where the biggest overreaction took place. But I would agree, a downside exists, Chava. Meaning most investors do feel it's going to be a soft landing. So if we get that disappointment, a lot of expectations have to get reset. Mm-hmm. And in that resetting process, sure, it could be a bit of a challenging time for investors. But even at the worst, let's say we get a hard landing. I don't think it's going to be 2008, 2009 levels of pain. I think you could see, a small contraction. I'm finding it difficult to forecast a protracted, deep recession that would lead to a full repositioning. I think it'd be a run towards safety, but then very quickly you'd want to look through the dust, clear the fog, and try to understand where the good opportunities were.
And we would see a much decisive action from central banks as well, right? So.
Right now, the only way to make financial
space.
Conditions easier, right? We've got tight spreads. We've got low levels of volatility in general, at least in the first 6 months of this year. So financial conditions look pretty tight. The only way to ease it from here is those central banks. So we do need the Fed and other central bank actors to come through. But I'm pretty confident they've been rational agents so far. I don't expect disappointment there.
Okay, excellent. So just to wrap it up, so basically we are more on the view that a soft landing is a higher base case, more probable scenario. We're watching recession risk as it might keep going up, but it's still not our base case. And that would leave us to a positive view for equity, but also for bonds as well, right? Particularly if we see central banks moving lower. Now, in terms of alternatives, it's more, what I get from you is basically you're positive on the commodities. It is gonna get positive for the other sectors of the alternatives, but maybe not now. Maybe
not now.
Yeah.
You have to underweight something. You can't just overweight everything. And while we like commodities, we're underweight on infrastructure and we're underweight on REITs today, for example, among liquid alts. Mm-hmm. Illiquid alts, you can't reposition tactically, right? They're strategic investments, not tactical ones. But when you look at that complex, we like equities a little bit. We're neutral on fixed income. Our underweight is in alternatives in those categories I mentioned, and in cash. For a long time, cash everybody was running to cash when you could clip a great sort of coupon on the high level of short-term rates. I think cash is beginning to fade a bit in some of its popular time deposits. Those are some things I think that I would underweight my cash in some alternative sectors. Instead, look at fixed income equities.
Okay. So I think that pretty much does it. Thank you very much, Todd. Thank you very much, Thor.
Happy to be here.
Charlie, Federico, thank you very much. Pues muchas gracias a todos. Y vamos a pasar a la sección de preguntas y respuestas. Les recordamos que pueden hacer las preguntas a través del chat, pero también pueden hacerlas en vivo. Muchas gracias.